buying of stock. The buyback bonanza is raging, and it continues. From June of 2006 to the first half of this year, the biggest companies in this country, we're talking about the ones in the S&P 500, they spent more than $700 billion on buying back their own stock. Now, conventional wisdom says that buybacks mean big bucks for shareholders. And it says that if a company is buying back its stock, the company fundamentally believes that stock is too cheap. All right, is this true? Todd Rosenbluth is an equity analyst with Standard & Poor's. And Todd, we were telling everyone at the top of the program about this report that you wrote. This is a topic near and dear to my heart. Is every time you hear a big company say they're going to be buying back stock, you often get a pop in the stock price. And it always seems to me that if they really believed in their business, they'd increase the dividend or they'd go invest the money somewhere. Why do a buyback? You've actually run the numbers. Do buybacks pay? Well, we at Standard & Poor's say that often it does not. Myself and Stuart Glickman at Standard & Poor's Equity Research put together this study looking at the 18-month period through June 2007, and we found that often companies that are buying back stock have underperformed not only the S&P 500, but they've been purchasing stock at a premium to more recent levels. Companies are buying back stock. We think it often tries to send a signal, but what it's doing is actually paying a premium often to versus current levels, and that's a concern to us, and investors should dig deeper into the numbers. Well, they certainly should, because obviously if they're paying a premium, that means the stock obviously eventually ends up going down. So that's the first conventional wisdom you've just debunked. Stock prices go up as a result of buybacks. Here's the second conventional wisdom. The more buybacks you do, the better. Companies that are serial buybackers tend to be rather loved among pundits. That is correct. And what we've done, we did an aggressiveness measure to see how aggressive companies were in buying back stock as a percentage of their market cap. And we found a number of companies that stood out that have been buying back stock at high levels versus where the market cap is, and they've underperformed not only the 500, but the stocks have gone down. Often it isn't rewarding shareholders when we see more aggressive chances. Sometimes it is, and we've got some companies that we can talk about where it's been a positive, but often it's not, and investors should, again, dig deeper into that, as we have at Standard & Poor's. All right, we've got the ones that were buyback bummers that didn't work. Let's zip through these here. Circuit City, KB, Pulte, Syndex, Countrywide. These are guys that did buybacks where it didn't pay, right? That is correct. These are companies that bought back the stock at higher levels than where the stock is trading at recently. And my colleagues at Standard & Poor's have investment recommendations that take that into account, but that's not solely based on buybacks. All right, what are the companies that have bucked all of the trends in your survey, and actually the buyback did end up resulting in, well, obviously correlation is not necessarily what is the case here, but the companies that did better after a buyback? We've seen a number of companies that have done better. We've seen some technology companies. A company that I cover in the telecom space, CenturyTel, which is probably not listed on the top of anybody's list, Standard & Poor's as a hold on, has bought back the stock at what is now 15% lower levels than where the stock is trading at. There's a lot of stocks in our study, a lot of stocks we can go deeper into, but I don't cover them all, so it's really tough to go into. Right, so you're just saying on an overall level, don't just assume a buyback headline means the stock is going to go up. Some of them do, but obviously when you take it as a whole, they did not over the time frame you looked at. You're actually saying as a bottom line here that for most companies, better than a stock buyback is just go ahead and sit that money in cash. You'd do better for your shareholders. We're saying based on the study period that we did, we looked at the investment alternatives, including investing in a company, buying back stock, paying a dividend, a number of things. We found that companies that bought back stock underperformed the rate they would have gotten had they kept the money in cash during the time period and are in Treasury bill or Treasury bond rates. In fact, we also found companies, the 77 companies that did not buy back stock to a level that we found significant, they actually outperformed on average the broader market and overall companies in general, and that's something to take note of. Absolutely. And Todd, thank you very much. A fascinating report. For those of you that want it, check base with Standard & Poor's. There's a great report here on how rewarding is corporate share repurchase activity, talking about challenging conventional wisdom. Now get ready to stop trading. We've got crude near $100 a barrel.